Hello, everyone. I'm David Darst, here to give you some thoughts about January. January comes from the Latin word Janus, who was the god of doorways. And therefore, January is entering a new year. It's been a somewhat volatile and rocky start to the month. We've had interest rates going up. We've got earnings reports. We're going to give you more about that in a second. We've had the big Fed meeting. So let's start out with the S&P 500, which closed on Friday, January the 28th at 4431. It's down about 7% for the year. The Russell 2000 is down about 12%. The transportation index is down 8.7%. And the bank stocks, the KBW Bank Index of the 24 largest U.S. banking companies is up 1.7%. Now, there's been some significant moves in the U.S. Treasury bond market. The two-year Treasury, it's gone up 37 basis points, 1.15%. The 10-year has gone up 15 basis points to 1.78%. And the 30-year has gone up 6 basis points to 2.07. So what's happening, short rates are rising faster than intermediate and long rates. That means the markets, investors are thinking, well, with interest rates going up, that may slow, and economic growth and profit growth slowing, that might mean that the bond yields do not have to rise that much. And most of the interest rate increase has been concentrated, as you can see, in the short end. When we finished 2021, the difference, what they call the interest rate spread between the 2-year and the 10-year, was well up into the 80s. Now it's 178 minus 115, and that would be 63. You want to be very careful as that margin begins to narrow to 50 and below, and maybe even go negative. That is a precursor. It's a pretty good indicator of an impending recession. So people are watching that 2-year versus 10-year spread. We're watching it as well, and we will keep reporting to you on it. Oil prices, the West Texas Intermediate, it's up 15.4% for the year thus far, closed at 86.82. Brent, which is the international oil marker, is at $90, and there's a whole chorus of forecasters talking about Brent very possibly going to 100. You have OPEC in a very disciplined manner, OPEC Plus, managing the supply very well as demand is beginning to come back. It's growing. So, and let me tell you, the much of the energy sector has really reduced the amount of exploration and production. So new supply, that's another reason that oil prices have been rising. Longer term trends with the environmental movements and so forth, and hydrocarbon pressure on hydrocarbon companies, the oil supply has been not added to in a significant way. So you have demand up and supply is somewhat constrained. You talk about gold. Gold is, with interest rates up, gold is down 2.3% thus far at the end of January at $17.85. Volatility, 27.66. The long-term average of the volatility index, VIX it's called, is 21. It's now 27.66. As you may have witnessed, as you may have seen in the month of January, at times it got above 30. Now, that means that plays into one of our themes that we've been talking about. We've got to prepare for increased volatility. That means moves up as well as down in securities prices, both stock prices, bond prices, and of course currencies. During the month of January, we've had also the fourth quarter preliminary number for the GDP of the United States. As you know, the first quarter was 6.3%. As you had that big growth in the first quarter, the rebound coming out of 2020, which was the onset of the COVID-19 pandemic. The second quarter continued 6.7%. The third quarter was up only 2.3%. We found that people were able to manage the Omicron variant of the pandemic, and the fourth quarter first estimate was 6.9%. People were very, very pleased with that. It looks like when you put this together, you've got two more estimates before we get the final of the fourth quarter, but it looks like 2021 is going to come in up 5.6% after 2020 was a decline of 3.5%, in that neighborhood. The number for 2022 right now is estimated to be up 4.0%. That will change as we move through the year. Now, let's talk about the Fed meeting. Let's talk about earnings, and then conclude with the themes that we have that we want you to be paying attention to. First, the Fed meeting. It took place on January 25th and 26th. Chair Jay Powell, in his news conference after the meeting, he basically made 3 points, and that's one reason why the market interest rates have been rising. First was, he said you can expect the first policy interest rate increase most likely after the March 15th, March 16th meeting of the Federal Open Market Committee. He said, secondly, no more quantitative easing. Starting in March, it's finished. No more adding money to the government bond market and to the mortgage securities market. No more of that. And then he said, when that is finished, then we're going to begin to let the Federal Reserve's humongous, very large balance sheet, almost $9 trillion now, let it begin to decrease. How? We're going to allow, when securities mature or when coupon payments come in, they're not being reinvested in new Treasury securities and mortgage-backed securities. So that's the third part of this message. And I think people are really wondering whether the Fed is going to stick to this schedule, or are they going to maybe even be flexible and accelerate their monetary policy tightening. So this is what put some pressure on the markets. Day to day, it was up, it was down. So there was a fair amount of volatility in the month. Earnings, so far, a few things on earnings. S&P 500, 170 out of the 500 companies have reported earnings thus far. The average the average earnings beat versus the forecast of the analysts has been about 5% for the fourth quarter of 2021. For the third quarter, that was 9%. For the second quarter, the average beat was 17%. And for the first quarter, it was 20%. So as you might imagine, the reaction to these corporate earnings reports has been quite mixed. And after the companies reported earnings, the stocks went down. GE went down 9%. Tesla went down 12% shortly after they reported earnings. Most people have also been focusing on the chief financial officer, the chief executive officer. Most of them have been saying, well, things are going to get better. Just wait till the second half of the year. And investors have not liked that. That's why we've had this distinctly negative. The average move after the third quarter earnings came out, the average move of all 500 S&P 500 companies was up 0.1%. Okay, it went up a little bit. The average move this time for the fourth quarter of the 170 companies that have reported has been down minus 1.2%. The outlook for the full year right now looks like it'll be around 9% up for the full year. That is, I think, a bit conservative, and in my humble opinion, that very well might be exceeded. Let's wrap up today with some themes that we want you to be thinking about. Theme number one is transition. Theme number two is growing but slowing, okay? We are in a new this is not the same monetary policy environment that we've had for a couple of years or even longer. We're in a new tightening. China is basically gone from being very constraining and conservative to stimulating theirs a little bit. And that's why you have the Baltic Dry Shipping Index. It's down 37% this year. Remember, we watched that because it gives us some indication of shipping not of containers, but of iron ore, of grain, of coal, of construction materials. And that's down about 37% thus far this year. So China is looking to stimulate. The U.S. is looking to basically get inflation down. Unemployment has come way down. Inflation is the key focus of the Fed now. And I think financial markets, inflation is the key. Growing but slowing, transition, and volatility. Those are the three themes that I would add a fourth theme, which is quality. Stick with quality investments now. This is not a time to go out the speculation curve or to go down the quality curve. Now, what could surprise the markets? What are the things that are going to determine where the market goes from here for the rest of this year? First of all would be the inflation picture. And the inflation picture is going to influence the Federal Reserve. So if the inflation picture can begin to come down, the Fed can actually say, you know what? We're going to take it really slow, and we're going to take it really nice and measured, the pace of interest rate increases. The markets, I think, would like that. There have been many times in the past where the stock market has gone up even as the Fed is beginning its policy of interest rate increases. But very key is the pace, and for the Fed to basically say we're going to do it in a very slow and measured and predictable way, you've got to see this inflation come down. The second thing is earnings. You want to see whether people are coming back to work, whether they're flying, whether they're doing business, whether they're consuming. There's a lot of pent-up demand still out there. You want to watch retail sales. You want to watch personal consumption and see how the economy is doing. If it's doing better, that I think will help asset prices. And the last thing, of course, we should be very vigilant and watchful about the Omicron variant. The Omicron variant, basically, is it passing? Have we come through the peak? Some other countries have already done this. Has the United States come through the peak? And therefore, the cases and people are feeling much more confident. They've got vaccinations. They've had the virus now. They've become somewhat immunized, and their immunity is strong, and there's less worry, and people are willing to go out and travel, spend, and get back to the office. Speaking of which, we look forward very much to coming back to the office and speaking with you next month. Have a great start to the month.